right, what is going on, Future Focus team? Back at it with another video. If this is your first time to the channel, thank you. Welcome. If not, welcome back. The purpose of this channel is to educate and entertain you, but the ultimate goal of this channel is to make you a little bit smarter today in order for you to have a better tomorrow. And with all that said, today we're going to be talking about some stuff that's a little bit different. We usually talk about wealth appreciation, but today, like, there's a lot of stuff going on in the world, and now that, you know, the virus has gotten a hold of, you know, where we live, it's kind of more realistic to us now. So today we're going to talk about more macro things that I want you guys to keep in mind, and it's more, this episode will be more about wealth preservation. So just holding on to what you have. So before we get started, anybody got anything? All right, so I'm gonna just show you guys some websites that kind of put things into perspective. So let me refresh this one right here. So this one right here is called usdebtclock.gov. Have any of you seen it before?
I think once in school years ago.
Yeah. So this right here, man, it kind of puts into perspective what is going on in the economy at the moment. So as I'll zoom in right here, and this will show you currently what the U.S. national debt is at. If you follow my mouse, you know, things like what the debt per citizen is, the debt to taxpayer, and there's a lot of crazier stats as you go through. So you look at the debt to GDP ratio, and it gives you for perspective what it was in the 60s, in 1980 and 2000, and where we're at now, which if you look at it, it's kind of insane. Like, we've doubled it and almost about to triple where we were before. This is where the U.S. total debt is at, $80 trillion. It'll show you how much savings there is per family, which is 23,000. But again, that's, you have to incorporate when it says per family, it also keeps in, like, Bill Gates and his wife would be in this, you know. So I'm sure they have a lot more in savings that contribute to influencing this number to go up. So as we go down, you'll see things like, you know, household assets. You'll see certain things in green. However, things like Social Security, Medicare liability, U.S. funded liability, and liability per children, these numbers are highly alarming. What's up, Diego? Welcome. So these numbers right here are highly alarming. All right. So one of the biggest numbers right now, and one of the biggest things we have to worry about, is this number right here. So currency and credit derivatives right now. So basically derivatives are, I think I pulled it up right here just for easier explanation. So in finance, a derivative is a contract that derives its value from the performance of an underlying entity. This underlying entity can be an asset, index, or interest rate, and is often simply called the underlying. Derivatives can be used for a number of purposes, including insuring against, hedging, increasing exposure to price movements or speculation, or getting access to otherwise hard to trade assets or markets. But in a nutshell, a derivative is something not real. It's you're either let me go back to that one. Like, what are derivatives in finance? So one type is a future. So if you've heard of purchasing like fuel futures, a lot of people went bankrupt recently because of in May, when the oil, when it went, do you guys remember when oil went below zero? Were you guys tracking that at all? Were you guys, so wow, so oil in like the end of April, beginning of May, it hit an all-time low. Already when it was at $20 per the price per gallon, that was not gallon, I'm sorry, barrel. When it was a $20 price per barrel, that was already like extreme low. However, because of these derivatives and the futures market, it forced the oil to drop below zero for the first time in history. And it even went to like negative 35. So do you guys know what happens when oil goes negative? Like, because a lot of people are like, how can oil go negative? How can you not make negative? Do you guys know what that means? All right, so cool. So basically, all it means is that at the same time, simultaneously, Saudi Arabia and Russia, they were uh, like bidding against each other and saying, they weren't going to slow down. So obviously, because of what happened with the pandemic, everywhere across the world shut down. And when things shut down, factories that are pumping oil, they're still pumping oil. And what ends up happening is if people aren't going to the gas station to get oil, then obviously that gas station doesn't need to buy oil. So all the trucks that were going to deliver oil to that gas station, you don't need those anymore. So now that gas is sitting somewhere and not being taken anywhere. So what ends up happening is that the US was producing so much oil that we had nowhere to store it. And what ended up happening was that they had to pay like either tankers, like tanker ships, to hold it onto their ships. That's a big reason that a lot of these tanker stocks, like they jumped up briefly, because they are getting paid by the United States of America to store oil. The Trump administration acted really fast, and what they did was they purchased a lot of the oil and they put it into our oil reserves. So they kind of like took some of that burden. However, a lot of people got hurt from that because like really small fuel companies that you've never heard of, like all of them have gone bankrupt. If not, they've been absorbed by the bigger echelons such as BP, or Exxon Mobil. Um, and a lot of these companies are on the brink, especially if we go into another shutdown in the states, which a lot of the states are beginning to restrict their leniency that they had prior, because cases are starting to come up again. And again, there's nowhere to store that fuel. Currently, like a lot of our oil refineries have been halted, so we're not producing oil. And the big problem with Saudi Arabia and Russia is that Saudi Arabia can sell oil for like $2 a barrel and not lose money. So the more they continue to produce, and when they expand, they can like really shut us down, like as our America being producers of oil. So basically, that's where the derivative comes into part with that is is like is a way of gambling. Like you're trying to gamble on what's going to happen in the future. So people are gambling that the price of oil is going to go up. So what ended up happening was people, when they got to like, when it dropped, it didn't drop automatically to negative 30. It dropped first to like 8%. It's $8 per barrel. And when it dropped there, a lot of people were like, wow, they put like freaking millions of dollars into it. And what ended up happening to the futures was they dropped below zero. So not like there was one news article I read where this one investor, he was on Robinhood, and he put like $1 million into one of these fuel futures. And what ended up happening was it went negative. And when it went negative, like he got basically notified that he had to pay. So he had to pay like $30 million or something like that, which he didn't have it. So the app, Robinhood ended up taking the blunt of that, and they ended up paying for it. And they just said, whenever it goes positive again, you pay us back. Whenever it went positive, he still owed like $300,000, and he still hasn't paid it back. But they'll probably eat that one as well. So yeah, going back to these, like these are this is something that you can look at, is the website's right there, us clock debtclock.org, and it's live. Like it doesn't stop, and these numbers keep growing and growing and growing. So these currency and credit derivatives that we're talking about, these are those futures. These are all these people that are gambling. That's how much money is gambled right now. So if things go wrong and things don't play out the way these people are gambling that it's going to play out, that can cause a lot of trouble in the economy. Um, so, any questions on this at all?
Nope.
No. All right, cool. Another, since you guys are into the stock market, another website I'll teach you guys if you haven't seen it before. This one's called Short Squeeze, and this one's good because just throw out a random ticker symbol, any company.
KO.
KO. So basically, you just come here and you just look at the amount of interest, short interest there were currently and prior. So prior just means before today. And certain companies, like you could gauge this and see where the investor sentiment is on where like, the stock is going to go up or down. So I guess a bigger one would be Tesla, because this one is the one that's like heavily shorted. Well, it was heavily shorted, but the amount of shorts in this one, you can see a bigger difference between this one and Coca-Cola. So the amount of shorts in this one has reduced. So prior, there was 15 million people shorting the stock, and now there's 13,960,000 people shorting the stock. Does anybody not know what shorting the stock means? All right. So basically, it just means it could be two things: people that are selling it, or people that are have puts. A put is just basically an option that says if you're buying a put, it means you feel that the stock is going to go down, and it's just another gamble. So a lot of this is just puts that are people are putting on Tesla, saying that the stock is going to go down, and if the stock, like when they buy a put, for right now, I think right now the Tesla is at 1,500 something. So they'll buy a put saying that it's going to drop below, let's say $1,300, and it could be either next week. If it's next week, the amount of will be more expensive. The later on you buy it, it'll be cheaper, and it's just basically a gamble. And certain different things could happen depending on where you are in the put or the call. But this is just showing you basically the puts that are put on Tesla and people that are short selling the stock. So this is a good website to look at. You can sign up if you want to. I didn't sign up. This is info you could click on, and you don't have to pay for all this, like just this generic info. But these could like if you're, it could be another tool in your toolbox if you're thinking about buying a stock or selling a stock. Um, it's called the shortsqueeze.com. Is there anybody want me to look up a particular one right now? Let me look up Mass Orange's favorite. I think it's that one. All right. So
hey, I made 23 G's.
What'd you say?
I made up 2,300 this past week.
Oh wow, yeah, that's great. That's
I
the
mean, then again, I sold at an average price of 296 a stock, and right now it closed on Friday. What I think at 307. Oh well.
not. It's not. Oh well. Another learning curve. Whenever you sell out of a position, you want to sell not everything at once. You want to like, if you get to $3, you'll sell 20%, and then when it gets to 307, you'll sell 20%, and you just you could play it like that, so you don't lose either way. If the stock drops down, you pull some money out and you made profit, and then the stock keeps going up, you just pull out a little more whenever you feel more comfortable pulling out a little more. And these are little thresholds you can set for every stock. Is different, every stock moves different, so you can have like a different percentage for each and every stock that you own. And it's just the learning curve. Like I did the same thing. I made a few choices where I sold everything on it, and then the same thing happened. Like maybe it dropped, but then when it came back, it like shot past where I had it before. So you lose out on some gains, but if you don't sell everything, then you won't lose out on all the gains. You could sell a little more when it goes up to that 307 or 308. What's your next? Did you sell everything you had when you sold?
No, I saved about 200 shares. I sold about 2,800 shares that I had initially. But then I started buying back in when it dropped down to, like I said, the 280 price is like the recommended price. If it drops below 280, that's when you want to invest into. So my buddy Alex has been doing this, following this stock for years. That's his recommended advice, is that when this stock drops between 280, it's best to invest in it and then swing trade it, a couple of days later, depending on how many stocks you buy, obviously. Like I said, with fuel cells, I've been invested in this since like November of last year. When I sold, my average price a share was 213, and then I sold it at 296, and that's 2,800 shares. So yeah, I made 2,300 bucks. So again, even after I sold, I reinvested and bought a couple more shares just to see, hey, what's going to happen with the stock now? It jumped up 307. I'm not buying right now. I'm waiting for it to drop back down to 280, so I'm going to reinvest again because I know this stock has the potential to raise up that value. So again, for those of you that are interested, what I've seen of this stock, it's a very good swing trade stock. Buy even if it drops down below 280, I kept buying. It dropped down to 250, dropped down to 240, 230. I kept buying shares, like 150 here and there. Why not? So it elevated my shares that I held. So when it got to that price, I decided, you know what? Let me go ahead and just take the gains this time instead of holding. I decided to do that. But then again, like I said, I took that profit and reinvested across my board of all my shares or my portfolio. Like I said, try to, where I was red, try to get to the at market price. And since then, I've been seeing a lot of progress. So again, days where the market is red, I've been buying. So again, it's averaging my portfolio, so that basically I'm gaining, but I'm losing, but it's not as bad.
What's your overall outlook on that stock? Like, do you think it's eventually going to be a $30 stock, $50 stock, or do you think it's always going to be like a under $5 stock?
It's probably going to be, according to my buddy Alex, it's going to be a under $5 stock always. But from what he said, he lives by the stock. It's made him millions. But what he says, and again, if you don't follow my buddy Alex Dean, I'll send some in the chat here after we're done. Recommended stocks that he recommends for long term. But overall, like I said, if I would listen to him in beginning of June when it got up to 30 something, if I would have showed those shares and reinvested, like he said, at 280, I would have had more than 2,800 shares to sell. I probably would have had 5,000 shares. It would have made more. So again, this is one that you want to keep, look at, sell when you gain a profit, whether it be 200 bucks, 300 bucks, and then reinvest when it drops below 280, even 270 if you want. So again, like I said, this stock is a very good swing trade stock.
Yeah. Any questions from the peanut gallery? Lee, you always got some questions. All right. So now that we've talked all this negative stuff, we went through all the debt and where everything is at. A big reason I bring this up is because there's been underlying articles that I've been reading where it's just alarming things going on that's under the radar. For example, the IMF, if you're not sure what that is, so there's our bank system. On top of our bank system is the central bank system. On top of the central bank, there's something called the International Monetary Fund. And this is comprised of about 180 countries. And, it manages the assets for all these 180 companies. And it keeps tries to keep control on everything. And what they've been doing is buying an alarming amount of gold in record prices that they've never done before. And if you don't know, gold is used as a hedge against the stock market, against real estate. It's an asset that is always appreciating, even though it really appreciates at a really slow pace. It still appreciates. And a lot of people are getting out of stocks, getting out of the, any other type of investing that keeps their money out of their hand and investing it into gold. Um, and where the International Monetary Fund, so if you see here, it just shows you what every country has in their precious metal reserves. Um, so this could be things like gold, silver, um, and it shows you where they've been raising. And a lot of countries have been like crazily buying gold and putting it into the reserves, which means like, you know, it makes you think about everything that's going on. Like, why are they doing this? This is the kind of things you guys should look at. For example, like Warren Buffett, considered one of the best, you know, stock market investors of all time. He sold all his airline stocks for a loss. You know, why would, and people are like, instead of, a lot of people are like, oh, he's so dumb, like how, why would he do that? We held him at a high regard. But like a lot of people aren't looking at the why did he do that? You know, what does he see that everybody else doesn't see? Instead of looking at it from the perspective of, oh, if I had those stocks, I would have done this with it. Figure out, why did he do what he did? When, think about it, he didn't need that money from those airlines because he had $130 million on the sidelines. So when he pulls out all the money from all his airline investment and he does it for a loss, it tells me like he has plans to put this money to work somewhere else that's going to, in the longer term, make him more money than the airlines will. And he'll make up that loss and get more gain. And he already made a move. I'm not sure if you guys are tracking. He made a $10 billion investment into Dominion, their fuel. So he's not fuel, I'm sorry, but he's like, he just made a big freaking investment and he got a hell of a steal on it. So if you guys don't know, Dominion is a electric company. Like, they are centered around the eastern region, around Quantico. Like, they have that area. There's also Duke up there. But yeah, so like, keep in mind, look at what these big investors are doing, and a lot of it's public. Like, it's not even under the radar. A lot of this stuff is public knowledge. And if this stuff were to break down, right? Let's say our economic system were to break down, what's really going to end up happening is there's going to be a shift in wealth, like the wealth classes. So, for example, the middle class will probably disappear. The wealthier are going to get wealthier, and the middle class is going to shift down to the lower, like the higher lower class, or the higher lower middle class. But like the middle class as a economic system is going to totally diminish. um, and what's going to end up happening to a lot of these like brand new investors is they're going to end up losing a lot of money, and it's going to push them away. They're going to say, I'm never going to invest in the stock market again. I'm never going to do that again. And if that were to happen, that's your cue to jump in. Like, that's the real time you want to jump in. A lot of these companies are way overvalued, not the entire stock market. Um, right now, the small cap and the mid cap are still haven't reached their 200-day moving averages. But like, once you get to like, I pulled this up as well. Like, Tesla has become a gigantic bubble. Um, when when a price goes up on a stock, the valuation of that company goes up as well. So in 1 week, the valuation of Tesla gained $60 billion in market value. And this is based on, one thing you got to look at is that this is based on the news of what was it? They sold 70,000 cars. So you're telling me that because they sold 70,000 cars, the valuation should go to 60 billion for that company? So this is when these bubbles are created. And I don't want you to live based off the things that happen in history, but I want you to like still keep in mind that history has repeated itself multiple times. The same era we're living in, there was a similar era that occurred in the 1950s. It was called the Nifty 50s. And this is when companies such as McDonald's, Coca-Cola, they were the Apple and Microsoft of their time. Like people were paying like for a 10-year worth of valuation. Like the company's going to be here in 20 years, so I'm going to pay that now. And what ends up happening is that let me try to pull it up right here. Let me use Coca-Cola. So, for example, right here in 1998, let's use 1998 for example, they're paying a certain price, and then if you look, let's say you paid right here at 1998 at the high, you didn't make gain or profit in Coca-Cola until what is it? What, 2018? So in this one stock, which is a great company, Coca-Cola is a fantastic company. They're used all around the world, but you like think about that. 1998, 2008, and 2018. So in 20 years, if you bought here and you kept it this whole time, your stock did not make any profit. And this is like right here is the tech bubble. This is 1998. This is when the market crashed. So just keep that in mind. Like right now, that's where I foresee that we're at. Like a lot of people are, you got to pay attention to the fundamentals, and into the fundamentals comes a PE ratio, which is the price to earnings ratio. But most importantly is we have 10 minutes left, the forward PE, which is what you're paying for. Essentially, you're paying for the future of where you feel that stock is going to go. So damn, it doesn't even go into the 50s and 60s. But yeah, so these people here in 1998, they paid around $39, and they went maybe like 8 years, 10 years without a profit, maybe even a little bit more. But that's insane. That's not something you want to do. And if you're buying these stocks at these multiples, yes, Tesla will one day make all this profit, and they're going to live up to this expectation. They are a great company, but do you want to pay for that right now and pay for something 20 years out? eh, any questions on this stuff? We got like 10 minutes left.
I heard rumors that Tesla is going to probably be part of the SP 500. That they're going to lead. Their stock has made so much gains in profit, and it's been doing good. It's going to be part of that. So, if you have that money to invest in a certain amount of stocks, it's when I read it's recommended. So, for me at this point, I mean, I'm going to since I can buy fractional shares, I'm going to start buying little by little until, just see what happens.
I would buy Tesla on a decrease. Like I could seriously see Tesla popping and losing anywhere from 30% of their current stock value to like even 50 to 70%. And if you don't think that's possible, it's happened already. It happened when it went to 916 the first time. It dropped all the way. What was it, kid? Back down to 330?
Yeah, I bought a share one night at 300, so I'm making like $1,300 on that one share.
Yeah, so this is even though it's been going up and up and up again, and what he's saying is correct. It's had 4 consecutive quarters of growth, so it does qualify to go into the S&P 500. And if that happens, it's going to turn into an even bigger bubble, because companies such as Vanguard, they're going to invest and buy like 1 million shares of it, because they have ETFs, and the ETF which is a derivative. Basically, they go based on what the S&P 500 does. So, like for example, VU or SPY. If Tesla were to be added, they would have to buy shares of Tesla in order to keep current with what the S&P 500 is doing, and make sure those ETFs track. But ETFs, do your own research on them. They're kind of turning into their own derivative, like their own bubble. They're basically what the mindset behind it is that if every single person that had an ETF were to pull out of it at the same exact time, there would not be enough money to give every single person, like to get their money back. So whatever it says in your account that you have is not really what the actual fund has. But that's just something to keep in mind. But yeah, I'm not trying to discourage you from purchasing stocks or saying pull all your money out. That's not what this whole segment is about. This segment is about just having you think outside the box and just protect yourself. It can happen where, like, uh, I want you to go and look at what happened in Japan with their stock market. Uh, Japan's stock market hasn't really moved in about 30 years. It's been like their version of the S&P 500 has been like steady. Um, let's see, pull it up. I think it's the KSI or the ASX. Oh, the nickel. Yeah, so if you look at it in the year 1991, and you come and look at it now, like you can see where it's what it's been doing, and what happened before here. It won't show you in this chart, but it's exactly what's happening to us now. All these companies are coming up. Companies at that time it was like Sony, but now it's like Microsoft, Apple, Facebook. Facebook, not really. I think Facebook is still undervalued, but then you got Alphabet. All these stocks are like priced at a freaking crazy valuation, especially with what's going on in the economy. Um, so, if the bubble were to pop, like we could see this. Like this is not something that can't happen to us. And this used to be one of the strongest economies in the world when you're talking about Japan. Um, but I just, again, I don't want you to pull everything out. I'm not saying pull everything out of the market, but be prepared if this did happen, because you can take advantage of this. And a lot of the wealthy are going to take advantage of something like this happening. Just hedge yourself. The International Monetary Fund, the central bank system, they're all buying gold at a massive rate. Maybe look into purchasing physical gold, not a gold ETF, like purchasing actual physical gold and just having it as a percentage of your portfolio. A recommended was like anywhere from 1 to 5% of your entire wealth be in gold and gold coins. They also sell silver. You could buy bars, or you can also buy the actual coins or let's see.
Yeah, I had a buddy of mine that about 3 years ago, um, I really wasn't really paying attention to what he was saying because I didn't understand it. And he has a lot of gold and silver like on hand. And he's a strong believer that our economy is going to plummet at some point. And he just says that he's just ready for it whenever it does happen.
Yeah, and it's just a great way to protect yourself and hedge uh, anything else you have. The goal to having something, Ray Dalio calls it an all-weather portfolio. If you guys don't know who Ray Dalio is, he's a very beyond our, like way before his time investor, and he like he's has something called the all-weather portfolio. And basically what this does is, if the stock market were to crash, your portfolio would still remain the same because you had these other things that were hedging you. Gold has increased. Let's see, gold. It just does it at a very, very low level. There's been times when gold, because of this 10-year, 11-year bull market in the stock market, gold hasn't really been keeping up. But like now it's hitting all-time highs. Let's see. Let me close this. All right, so yeah, if you can see where the gold is currently priced at right now, it's 1798. For us to buy, it's closer to like, that's not what you're gonna pay. That's what it's priced at. So technically, we have to pay a little bit more because we're paying, you know, for whoever has it right now has to make a profit when they sell it to you. So you're gonna pay anywhere between 1800 and 1900. But if you look at, you know, what it's done, it's increased as well. It went a long time without moving because again, we've been in this 10-year bull market in the stock market. And that's another thing, like I got a minute left, but another thing to keep in mind, like the longest bull market ever in history was just supposedly cut short in a matter of weeks. And now we're back on another bull market. It's very hard to believe. Just go back and do your research and see when this happened in history before, what's always preceded it afterwards. Like what's always happened. It's always been, it'll drop, it'll shoot back up, kind of hit close to where it was before, and then it'll drop again. And sometimes it drops even deeper than before. So the last thing I'll leave you with, protect yourselves. Make sure you guys are always, you know, keep the chat moving. I've been busy here, so I haven't been really keeping up with it that much, but you know, keep it alive. I appreciate all you guys. We could do this as often as you guys want. And if you guys want to lead it one time, like, or lead it, like, just let me know.